so to
Call
speak.
it a sanction. I mean, it's the same thing.
Like
It's really not a tariff as much as it is a tax on all of these countries. And so, when you're talking about adding all of the taxes that they're talking about adding, you're talking 120% or more on China alone. Well, good luck. You're going to end up not only massively increasing the price to the American consumer, but you're going to piss off these countries, and it's just going to incentivize them that much more to quietly continue to do their thing. And, look, people always said the West wouldn't go down easy. I think when you put Trump into the administration, you could put an exclamation point on that. But in the end, these countries, as you mentioned, already have a greater portion of human population, of global GDP, of military might, of trade routes, both on land and sea. They refine 100% of all the rare earths. They produce the majority of them, as China is now no longer going to send them out to export them all to the United States. As this is beginning of retaliation. These are very interesting, challenging times, and Trump is basically saying to all these countries, if you leave us, well, you're gonna have 100% tariff when you can't trade in the United States. Well, I guess at some point these countries will have to decide what's more relevant and what's more important. But it's certainly not a good way, I think, to come into office and with an attempt to mend fences. And in fact, he's taken the other position and saying, we've been so weak for so long, I'm done doing that. This is the way it is. If you don't like it, tough. Well, I guess we'll see how that plays out. But probably wouldn't be my first choice.
Do you see that affecting the gold and silver price?
Well, I do believe that the Fed wants to let gold go higher. I think they won't stand in the way of it. I don't know that they're going to do what Cynthia Loomis, the senator from Wyoming, talks about, immediately revaluing it. But I do think that it would behoove them and it would enhance the balance sheet of the country to let gold go higher. Right now, the trend is risk on. Right now, it's risk on trades in equities and in cryptos. There's a very strong link between these stable coins like XRP and XRC, I think it is, that are massively tied to the bond market. Right now, as much of the world is selling our treasuries, these stable coins like Tether and XRC, I think, it's part of Goldman Sachs. These balance sheets that back these stable coins that are being issued are 85% U.S. treasuries or thereabouts. And so people trying to leave the legacy system are only supporting it by going this route. It's one of the things that if you want to take a contrarian viewpoint, all you hear is crypto, 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 Bitcoin, Bitcoin, Bitcoin. But what are the big money? What are they buying? They're buying gold. They're buying farmland. They're buying physical, tangible assets. And what are the central banks doing? They're buying gold and silver. We don't see them buying crypto. Some people think it's a rug pull. I'm not going that far, but what I will say is that, I think you kind of tune out the noise and look what the big money is doing. And the big money, most of it around the globe, is still buying commodities. Now, with that being said, I wouldn't have a problem sitting back and letting things kind of unfold. Ultimately, gold and silver go much, much, much higher in what will be a very inflationary situation, a weaker dollar, lower interest rates, stimulus, if you will, a reduction of taxes. This is all going to create, I think, a commodity boom.
The current global financial landscape is riddled with complexities, contradictions, and strategic maneuvers that underscore the importance of precious metals like gold and silver. Andy Schectman's perspective offers an illuminating lens through which to understand these shifts. He doesn't merely highlight the value of these metals, he frames them as the backbone of sound monetary policy and a hedge against the unpredictable. In this discussion, we unravel the intricacies of his analysis and explore why gold and silver remain indispensable in the modern economic framework. The United States has long wielded the dollar as a tool of economic power. As the world's reserve currency, the dollar has allowed the U.S. to project its influence across global trade, finance, and geopolitics. But, as Schectman points out, this dominance is increasingly under threat. The ever-growing national debt, coupled with unsustainable fiscal policies, has eroded confidence in the dollar. With debt levels surpassing $36 trillion and a debt-to-GDP ratio nearing 130%, the U.S. is entering a precarious phase. This level of debt is unprecedented in history. Historically, countries with such staggering debt ratios have faced economic collapse unless drastic measures, such as hyperinflation or default, were implemented. Even with the advantage of a printing press, the U.S. faces an inevitable reckoning. The Congressional Budget Office, CBO, warns that by 2031, all federal tax revenue will be consumed by mandatory spending and interest payments. Discretionary spending, including defense, would need to be entirely financed through borrowing, which raises questions about the sustainability of America's superpower status. President Trump's proposed tariffs on BRICS nations and others have sparked significant debate. While intended to protect U.S. interests, Schectman argues that these tariffs may backfire. A 100% tariff on Chinese goods, for instance, would raise consumer prices in the U.S. dramatically, further stoking inflation. More importantly, such measures alienate key trading partners and push them toward alternative financial systems. The BRICS nations, comprising Brazil, Russia, India, China, and South Africa, are already taking steps to reduce their reliance on the dollar. Their increasing alignment is more than a geopolitical statement, it's an economic strategy. By developing alternative trade routes, payment systems, and even currencies, these nations are actively working to sideline the dollar. For example, China's recent suspension of rare earth metal exports highlights how such retaliatory measures can disrupt global supply chains and further weaken U.S. influence. Schectman's observation about the strategic use of commodities by the BRICS nations is particularly insightful. These countries are not just challenging the dollar, they are reshaping the rules of global trade. With control over key resources like rare earth metals, energy, and agricultural commodities, they are building an economic framework that prioritizes sovereignty and resilience over dependence on Western systems. In this environment of uncertainty and shifting power dynamics, gold and silver emerge as crucial assets. Unlike fiat currencies, which can be devalued at will, these metals hold intrinsic value. Central banks around the world are acutely aware of this. In 2023 alone, central banks purchased record amounts of gold, signaling a lack of confidence in fiat currencies and a move toward more stable reserves. Silver, often dubbed the poor man's gold, plays a dual role as both a monetary and industrial metal. Its applications in renewable energy, electric vehicles, and technology make it indispensable in the modern economy. Yet despite its critical importance, silver remains undervalued. This creates a unique investment opportunity, particularly as supply deficits persist. The Silver Institute reports a 260 million-ounce shortfall in 2023, a trend that is likely to continue as industrial demand surges. In a world where uncertainty is the only constant, gold and silver stand as beacons of stability. Andy Schectman's insights illuminate their enduring value, not just as investments, but as essential components of a sound financial strategy. Whether as a hedge against inflation, a safeguard against systemic risk, or a store of wealth, these metals are unparalleled in their utility. The global shift toward tangible assets is not a trend, it's a transformation. As nations, institutions, and individuals recognize the limitations of fiat currencies, gold and silver will continue to gain prominence. For those who act now, the rewards could be substantial. For those who wait, the cost of inaction could be even greater.
I don't know if he's trying to incentivize this, to incentivize a reset. Some people think that. I think he's overplaying his hand. First of all, you're going to significantly impact trade volume between the U.S. and the BRICS countries. And most of these nations, or many of them, are huge importers of goods to the U.S. So the tariffs, first and foremost, are going to increase prices for the American consumer. Not to mention disrupting the global supply chains, but to the American consumer, as these tariffs will not be paid by those manufacturers or those importers or exporters rather, but they will be paid by the end user as the producers will up the cost. That's first and foremost. It's going to strengthen the alliance. I think that they'll push these members closer together in an effort to double down, if you will, to establish their financial system that will be less reliant on the dollar and the treasury. I think that that's a given. You already saw China today just suspend all shipments of some rare earth metals. I was just reading it, and hell, if I can even remember what the names of them were. Let me see if I have. They're all like end in idiom. These are things that are used in radars and in batteries, and the rare earths. I don't even want to look for it, but they're already pushing back. And I think that what we will witness is just an all-out reduction in demand for dollars and for treasuries. The dollar's role as the world reserve currency is unlikely to face any immediate threats, but these tariffs will lead to retaliatory measures by the BRICS nations. They will escalate into broader trade conflicts, if you will, and it's going to strain relations between the United States and harm U.S. exporters. So, normally you implement a tariff to protect your manufacturing base, but we don't have much of a manufacturing base. We've offshored it all. So all we're really doing is adding a tax, if you will, or a higher price inflation on the end user, the consumer. This is not the way that you come in and mend fences by saying you must use our currency. One that, by the way, is another $750 million given to the Ukraine today. We're destroying the value of the dollar. Our treasury market has been unstable. And he is one who's advocating for lower interest rates, a weaker dollar. That's all, diminishing the purchasing power of the dollar. And so to make people take this, to force them to take a currency that has, not done much to preserve purchasing power and has been weaponized and is continuing to be weaponized, I think is a silly mistake, and probably will have really negative implications moving down the road. We'll see if he even gets them, or take it all the way to the nth degree. Is he trying to do the best that he can to create a controlled reset? That's way out there, and I'm not saying that that's going to happen. But look, if you wanted to get people confident in the system again and mend fences, this is not the way to do it.
As we delve deeper into Andy Schectman's perspectives, it becomes increasingly evident that gold and silver are not merely commodities. They are lifelines in an era of economic uncertainty. The discussions surrounding tariffs, trade wars, and the shifting dynamics of global power add layers of complexity to an already fragile system. In this continuation, we explore how these metals provide a unique solution to the challenges we face, from geopolitical conflicts to the erosion of fiat currencies. The US dollar's dominance as the world's reserve currency is no longer as secure as it once was. For decades, the dollar has been the linchpin of global trade, with countries holding vast reserves to facilitate transactions and stabilize their economies. However, as Schectman highlights, the BRICS nations and their allies are actively working to create alternatives. This is not a theoretical possibility. It's a reality unfolding before our eyes. China's decision to suspend rare earth exports, a move aimed at disrupting U.S. supply chains, underscores the growing divide. Rare earth metals are critical for technologies ranging from smartphones to advanced weaponry. By leveraging its control over these resources, China is signaling its willingness to challenge U.S. dominance. This strategy extends to financial markets as well. China and Russia have been aggressively accumulating gold, not just as a hedge, but as a potential foundation for a new financial system. These actions are not isolated. Across the global south, nations are questioning the wisdom of relying on a dollar-based system. The weaponization of the dollar through sanctions and other measures has accelerated this trend. Countries are seeking alternatives that offer greater autonomy and stability, and gold is emerging as a preferred choice. Its universal acceptance and intrinsic value make it an ideal candidate for a new era of international finance. While policymakers and central banks wrestle with the implications of these shifts, gold and silver quietly continue to prove their worth. Unlike fiat currencies, which can be printed at will, these metals are finite resources. This scarcity, coupled with their historical role as stores of value, makes them indispensable in today's economic landscape. Silver, in particular, is a standout. Its dual role as both a monetary and industrial metal positions it uniquely in the market. The ongoing transition to green energy and electric vehicles has created unprecedented demand for silver. From solar panels to EV batteries, silver is an essential component. Yet despite this growing demand, supply remains constrained. The Silver Institute reports a persistent supply deficit, with demand outstripping mine production year after year. This imbalance creates a compelling investment opportunity. As industries scramble to secure their silver needs, prices are likely to rise. For individual investors, this represents a chance to benefit from a trend that is both inevitable and irreversible. One of the most telling indicators of gold and silver's value is the behavior of central banks. In 2023, central banks purchased record amounts of gold, signaling a clear lack of confidence in fiat currencies. This trend is not limited to emerging markets. Even developed nations are quietly increasing their reserves. Schectman's observation that central banks are buying real things is particularly poignant. While retail investors chase speculative assets like cryptocurrencies, institutional players are focusing on tangible, time-tested assets. This divergence in strategy highlights the wisdom of following the smart money. Central banks, with their access to unparalleled resources and expertise, are setting an example that individual investors would do well to emulate. Despite these strong fundamentals, investor sentiment around gold and silver remains lukewarm. Mining stocks, which typically outperform the metals during bull markets, have lagged behind. Schectman attributes this to a lack of conviction among investors, many of whom are distracted by the allure of cryptocurrencies and high-flying tech stocks. This skepticism, however, presents a unique opportunity. As more investors wake up to the realities of inflation, debt, and systemic risk, gold and silver are poised for a significant revaluation. The eventual shift in market sentiment could create a bull market that dwarfs previous cycles. The key for investors is to act before this shift occurs. By the time the broader market catches on, much of the upside will have already been realized. Those who move early stand to benefit the most. Trump's proposed tariffs on BRICS nations and other trading partners have sparked significant debate. While intended to protect U.S. interests, these measures could have unintended consequences. Higher tariffs would increase costs for American consumers, stoke inflation, and disrupt global supply chains. Moreover, such policies risk alienating key allies and pushing them closer to the BRICS bloc. As Schectman points out, these nations already control a significant portion of global GDP, trade routes, and military power. Alienating them further could accelerate the transition away from the dollar and toward a multipolar financial system. For gold and silver, these developments are a double-edged sword. On one hand, economic uncertainty and geopolitical tensions tend to drive demand for safe haven assets. On the other hand, protectionist policies could disrupt supply chains, impacting the availability of these metals. Navigating this landscape requires a nuanced understanding of both market dynamics and geopolitical trends. Schectman also explores the possibility of a monetary reset, where gold and silver could play a central role. Such a reset would involve revaluing these metals to stabilize currencies and restore fiscal discipline. While this may sound radical, it is not without precedent. The Bretton Woods system, which pegged the dollar to gold, provided decades of economic stability. A modern iteration of this system could address many of the challenges we face today. The idea of revaluing gold is not as far-fetched as it may seem. Historically, governments have used gold to anchor their currencies during times of crisis. By setting a higher price for gold, they can effectively devalue their debt and restore confidence in their monetary systems. For investors, this scenario represents a once-in-a-generation opportunity to benefit from a dramatic revaluation of gold and silver. In a world where uncertainty is the only constant, gold and silver offer unparalleled stability. They are not just assets, they are insurance policies against the unpredictable. For investors, the key is to act decisively. Waiting for the perfect moment or the ideal price point is a recipe for missed opportunities. The current environment offers a rare confluence of factors that favor gold and silver. From supply deficits to central bank buying, the fundamentals are overwhelmingly positive. Add to this the growing geopolitical tensions and the erosion of fiat currencies, and it becomes clear that these metals are indispensable in any diversified portfolio. Schectman's advice is simple yet profound. Follow the smart money. Central banks, institutional investors, and seasoned market veterans are all betting on gold and silver. By aligning with these players, individual investors can position themselves to benefit from the next phase of the market cycle. Andy Schectman's insights provide a roadmap for navigating today's complex economic landscape. His emphasis on gold and silver as essential components of a sound financial strategy is both timely and timeless. As the world grapples with unprecedented challenges, these metals offer a beacon of stability and a path to prosperity. The global shift toward tangible assets is not just a trend, it's a transformation. For those who act now, the rewards could be substantial. For those who wait, the cost of inaction could be even greater. The time to invest in gold and silver is not tomorrow or next year, it's today.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.